All right. What is up? And welcome back to How to Invest in Commercial Real Estate.
Up? Oh, were you
That's
all
we. Geez.
No. Okay.
Last week Brian's yawning, and this week we just get hey.
Yeah. Hey.
Okay. Okay. Well, we just got back from Vegas. Super exciting trip.
That's why you only got hey. I'm tired. I'm tired again.
We went out there to tour a bunch of sites. It ended up being like 6 or 7 different sites, and we've only committed to 2. So it was kind of nice getting to, while we were there, get a glimpse of the future pipeline. We'll probably have a lot more stuff out there in the first quarter, it sounds like, after meeting with Andrew and his team out there.
So 2 deals that we looked at that we think are going to be coming down the pipeline is Carson City, Hard Corner gas station and convenience store.
Yep.
And then in Las Vegas, an auto body shop in North Las Vegas.
Perfect Auto.
Yep. And so shout out to Andy, our partner out of Fort Worth, because he's the one that connected us up on the deal. He's not always on the podcast, but we appreciate the awesome job he's doing lining up all these opportunities for you guys.
Yeah, so the Perfect Auto deal closes November 15th. It's a super small equity raise, so we're just kind of allowing a few select group of people. Your phone is auto-transcribing everything I'm saying.
Wow, you don't even need to use GPT this time. I've got the whole show right here.
That's great. That's great. Whoever got that text is going to love it.
Well, she hasn't got it yet since I haven't sent it.
Anyway, Perfect Auto. It's like a 1.27 equity multiple. We should be in and out of the deal in about 6 months. It's an existing building. We're plugging in a new operator. We've already signed the listing agreement to sell it. So it will literally hit the market the day we buy it or the day after we buy it. Andy met with the new operator. He's got a lot of locations out there. We drove by one of his other locations.
15 locations that he's already operating, right?
Yep. So that'll close November 15th. Look out for an invite.
All right. What's the topic today, Braden?
What's the topic today, Brian?
The topic today is how to evaluate the fees of the sponsorship of the sponsor in a real estate syndication. Yeah.
So through the podcast and through our business, we're constantly getting a lot of new investors who are interested in investing. And the first risk that they have to kind of debunk is the bad actor risk. And we have to do that same thing, right? Like that's why we flew out to Vegas to meet Andrew and the team and tour the sites and make sure all of this stuff is real and they're going to be good stewards of your money. And you have to kind of develop these series of questions that you can ask. So we just thought it would be an amazing topic today to kind of go into questions you should be asking a sponsor of a real estate development or us. And they're just good things to understand when you're investing into an LLC like this.
Yeah, we just made a list of the questions that we get, right? And the number one question is, how do we make money? Because our investors want to know that they're not being ripped off, that we're not just doing this to generate fees for ourselves. So they want to know exactly how we're getting paid. So let's start with the criterion standard fees. Maybe we might talk about maybe some other sponsors have additional fees that we don't charge. But what are typical fees for criterion?
Yeah, so the easiest one to start out with is an acquisition fee. So an acquisition fee is typically just 1, 2, 3% of the total value of the asset that's taken at closing when you close it.
And so that, by definition, acquisition fee. So those are the costs that we have some soft costs up front. We travel, like we just said, to go see some of these things. Obviously, we have employees and everything else, but so these are costs that we're trying to reimburse ourselves for putting the deal together.
Yeah, so
evaluating all the deals, and
we're billing any costs we actually incur back in addition to the acquisition fee, just because those costs are associated with the deal. It's really about the time and effort putting the deal together for our internal infrastructure. Like you said, we have an office of people, and it takes a team to put all of these packages together. So the acquisition fee is really just time and effort spent on that deal.
And just so I want to clarify. It's 1, 2. I haven't seen 3, but it could be a 3% of the total purchase price. So we just got to make sure we understand that. So if we're going after a $5 million deal, the acquisition fee for us could be $50,000 to $100,000. And so, like Braden said, if we go out there to the site, we have travel costs, we have to stay in a hotel, we meet with the developer, and we end up buying that deal, we will also charge those fees in addition to the acquisition fee. But here's the catch, guys, is that we're lining up deals every single week that we don't buy. And there are deals where we will fly out to a market and we're like, we don't have a great feeling about this. we don't like the area, we're not going to do this deal.
We lost $3,000 or $4,000 last week on a deal we dropped.
Yeah, and so those costs cannot be billed to a specific syndication. Those are costs that we eat as the sponsor.
Yep.
No investor should be obligated for a deal we didn't buy. And so that's why the acquisition fee is important, because it does help cover the time and energy and expertise that we have lining up the deal, but it also helps reimburse us for some of the deals that we didn't buy. And that keeps us motivated to keep looking for deals, because if we couldn't charge an acquisition fee and we weren't getting reimbursed for any of our travel, then we would have to be very, very selective on which deals we even looked at, because we wouldn't have enough money to fund a lot of deals not being able to get reimbursed, knowing that 90% of the deals don't follow through to a closing. So
the next one, you would say, right now we're doing a lot of developments. We're not acquiring properties. What is that fee? Is that the same? And it's not. We just charge a $50,000 fee to the investment company, the company that's raising the money, and that's an equity placement fees is kind of what we call it. The next fee would be a disposition fee, and again, that's typically 1 or 2%. It's typically only taken if we exceed the expected IRR, right? So like if we're advertising a 22 IRR and we sell and hit a 15, 16, 17, we're not going to hit a massive disposition fee. So it's kind of at will. We can take that.
It's discretionary, though, and just a little bit more to that point. The closer we are to the deal IRR, the more likely we will take a disposition fee.
Yep.
If let's say we said we think it's going to be a 22% IRR, and we ended up, and we can sell and take a 1% disposition fee and get you to a 21, we're going to do that. Mm-hmm. It's when we underperform as a sponsor, and let's say the IRR is going to be 5%. Or 10% or 0. We're not going to take a disposition fee at that point, because we know we've underperformed and we want to salvage as much of the investor returns as we can. So that's how that's going to go.
Yeah, the next fee is an asset management fee, and this is just 1% of revenue. Some people do this of 1% or like 0.25% of the asset value per year. Some people do this in the form of 1% of assets under management. You've got to have I think you have to have a Series 7 license to charge a fee on assets under management. So that's why we specifically don't do it, but I'm sure somebody out there doing it without the license. But yeah, an asset management fee.
You said it's 1 to 2% of the revenue generated.
That's what we charge. Yes.
Yep. And so I just want to clarify for everybody on revenue, because you have all these different NOI, revenue, gross, net profit, all that. So let's say you have a shopping center, and let's just say it's 50,000 square feet, and I'm going to take a guess here, but you're running, maybe 50,000 a month in gross revenue.
Redbud's 20,000 feet, and it probably has $50,000 in revenue.
Okay, so maybe maybe it's $100,000 on a 60,000 square foot center.
Yeah.
And so the fee would be $1,000 a month. So that's total gross revenue, whatever that number is, 1%, that's $1,000 a month. And to your point, that's really covering the cost of the daily bookkeeping.
That's not covering anything.
Well, it's not covering a lot of the costs.
The reports.
Yeah. But it's just a little bit of an admin fee, because we do have to
manage
the manager, manage the contractors on site, manage the investment software, get you the quarterly updates, print the checks, handle any questions, all of the day-to-day operational things with that asset. That's to help cover the overhead that we have with the employees to help do that.
Okay. Any other fees? You've got acquisition, disposition, asset management, debt fee. Did we talk about debt fee?
Yep, we haven't talked about that yet.
Yep. So we charge a 1% fee on any debt we have to guarantee.
Okay.
And we guarantee all of the debt on an acquisition. On some of these joint venture development deals, we've gotten out of having to sign on the debt sometimes because the sponsor's been strong enough to where we just weren't needed. Sometimes that's where we can add a lot of value to a development. It's by bringing our own lender, like this deal we're doing in Jacksonville, the Starbucks deal. That's our lender. So we got way better terms, and that kind of helped us win the project, so to speak, with the developers, because we brought all of the capital stack.
So it kind of pays for, number one, on every deal, we go out to get multiple quotes, right? And that takes time. So we're paying for our time. And then we do the personal guarantees on it. So it's kind of to cover a little bit of liability that we're taking on. Would you say?
I don't even think it's a time thing, right? Because the bank is typically charging origination. We would have to find a loan anyway. I mean, we could pay 1% to somebody else to help find us a loan. And I mean, every now and then you'll see us using a loan officer like that, very rarely. But yeah, it's really risk, right? So like, what do we like? I've personally guaranteed $100 million in loans. Look at my face. Look at this. I mean, it's just, it's risk, right? Yeah. Like at the end of the day, the investor's recourse is their capital invested. We have that same recourse with the same capital, if not more invested, but we can't just turn the keys back in if it doesn't perform. Yeah. They're suing the shit out of us. Mm-hmm. So that 1% fee is in exchange to use our balance sheet. And I think that's commensurate with any sort of bonding fee. I mean, a typical bonding fee is 1%. Yeah.
Okay, and I got some additional thoughts on this. Your points are well taken. It is partly to compensate for the risk. But let's just dive in a little bit to a question I had. Let's say you have a sponsor that says, hey, I don't charge a debt guarantee fee, but those guys do. They're worse. They're taking more from you. Okay, that would be the pitch. And I want to explain that because that is absolutely not true. There's so many sponsors out there that don't spend any time working on getting you debt. And so there are a couple different ways they can do that. They can say, hey, mortgage friend, I don't want to go to 30 banks and evaluate them and give them all this information and underwrite the deal and build a model and try to convince this bank to do the deal. But the mortgage broker will do it because that's what he does every day. And he's going to charge 1 or 2 points to the LLC that's buying the deal. So you're going to pay whether your sponsor does it or a mortgage broker does it. The next point I want to make is a lot of sponsors, they don't want any risk. And so what they do is they go out and get CMBS debt.
Lower leverage.
Non-recourse. Low leverage. 60% debt, 70% debt. The deal's at less risk.
Which negatively impacts the limited partners' returns.
That's where I'm going, is that they don't want any risk. And so then they provide lower IRR returns. Mm-hmm. And so what we try to do is we try to go for the highest IRR returns we can get. And sometimes the only way to do that is to go get personally liable debt. With our balance sheet and with our experience, we can tend to get lenders from a 60 or 70% on a non-recourse up to an 80, even 85% LTV on a recourse deal, which drastically improves the upside for the investor.
Plus, you want your sponsor personally guaranteeing the debt. I mean, at some point, the sponsor will outgrow it, but I don't necessarily understand people who will never sign on debt. It just makes me inherently not trust them, right? Because they're not fully committed. At the end of the day, they can bail. They can just say, yeah, this didn't perform as well. Equity, the money's gone. Lender, you can have the property back. Sorry. Yeah. And I mean, it's not good enough. You want to know when you're giving somebody money that they are going to hurt just as much, if not more, probably more than you.
No, that's a great point. Is like, even though we're taking a small fee, if we go out and do the hard work and find better debt, and if we sign our names, but you definitely should like that aspect because it makes us fully invested in the success of that deal. Yeah. So
okay, both of you made really good points. Okay, we got to keep going. How about promoted interest? Is that considered a fee?
No.
Okay. Well, I've got a question for you.
But it is part of how we get paid.
It's part of how we get paid.
Yeah,
and that's the big part.
All right, let's hold off on that because I do have another question about that. So the second question I would have and that we've gotten is, how do we make sure that our investors' interests are aligned with our interests?
Yep.
So that we're all, going towards the same goal.
Right. So far we've talked about fees. We've explained the upfront costs we have and why the acquisition fee helps that. We've talked about the asset management fee and how that covers all of the day-to-day activity and administration of the deal. We've talked about a disposition and a debt guarantee fee and why those are important. Okay, but none of that is really aligning the investor interest with our interest. But that's also not the big profit center for us. The big profit center and where we make most of our money is on the back-end sale. And so how we align our investor interest with ours is we do the promoted interest, or commonly known as a waterfall, where if we can hit certain hurdles for the investor, any amount over that, we share in those profits. And so that's what the carried interest is, or that's what the waterfall is. And so Braden, why don't you kind of explain how we go about sharing the profit over a certain return?
Yeah, so most every single deal, there's some sort of preferred return, or if there's not a preferred return, it's just a split of profits, right? So if we don't make any profits, we don't make any money. I mean, it's very simple. We have to get profits to the limited partner, and then we get a small percentage, like, 30% of 1%, so that's what we get of every percent after 8, typically 30 to 50 cents on the dollar of every percent after 8. So we're finding assets that are purposely delivering 25, 30% IRRs because we need to know that we can get the investor, 18 to 20, and then there's a little bit left over from us. I mean, that's the name of the game is we're allowing people to invest with us in great investments. And that's the other big way we're aligning the investment, right? Is we're literally making ourselves in an equal position because we're investing in the same fund you are. And that money's treated the exact same way. So we want it to perform as well as you, and we want it to not disappear just like you. So that's immediately aligned.
Not only are we investing, we're the largest investor.
We're typically the largest investor. Yeah. And we're personally guaranteeing the debt. And we make the lion's share of our money if we deliver you, or we start to make money after we deliver you 8%. And people ask all the time, why'd you pick 8? And the reason, in my personal opinion, why I picked 8 is because if I can get you 8%, I feel entitled to start sharing in profits. 8% is kind of like a bare ass minimum market return, in my opinion.
Okay, guys, ask yourself what all financial planners tell you about investing in the market. They're like, don't worry about the ups and downs. Over the last 80 years, the S&P and the Dow and the NASDAQ have averaged about 8% a year.
Exactly.
So it's a good number. And he's saying is that if we can deliver 8% to you, which is what the market's going to give you over time, then we want to share a 30% share, 40% share, 20% share of the profit over that number. That's all. And so that's how we align our interests. So if we can get you to 15, right, that means that we got 3-4%. If we can get you to 20, that means we got 5-6% potentially. However it's laid out.
Again, the promoted interest on these deals, like some of these shopping centers will hold for 5, 7, 10 years. So again, we're not making the lion's share of that money until the asset is sold or refinanced. I was
going to say the same thing. To me, the fees that we charge just kind of pay our overhead, right? Our year-to-year
100%
overhead. We don't get paid the lion's share of what we're getting paid for 7 to 10, maybe longer years till we sell the property, right?
That's why I refer to myself as Excel sheet wealthy.
Right.
Because it's just like every joke you've heard about the real estate developer being broke is 100% true.
Yeah.
All right.
Okay.
Next question.
Okay. So I think you covered, my next question was how the waterfall works, but you explained that well.
Yeah, so the waterfall specifically is the portion of the operating agreement that is titled distributions. For us, it's the 4th section, and it is the most important part of the operating agreement because it's what says, hey, when this entity makes money, where is the money going? Mm-hmm. In our case, there's 2 different waterfalls. There's a waterfall for operations, and there's a waterfall for an exit. The waterfall for operations is the preferred return, typically 8, and then a 70-30 split is typically standard. Sometimes we'll take a little more than that where, we're the 30, the limited partner is the 70. Like I said, sometimes it goes 40-60. We've had one deal where it was 50-50. And then that's just operational cash flow, right? So if that asset makes money, doesn't have a capital event, that's how you distribute cash. That's how you, if we don't follow those rules, you can sue us for fraud and win. I just told you how to win. Yeah. The next section is a capital event. This isn't always a sale. A lot of the times this is a refinance. That's kind of the ultimate home run for us, is to be able to keep the asset, return the equity back. So this portion of the waterfall is for a sale or a refinance. Like I said, we will pay the preferred return to that date that we're making the distribution. We have to return all of the capital, and then it's that same split that it was in operational cash flow. We'll get 30, 40, 50% of the profits after you have your preferred return to date. You have your money back. That's when we'll get the promoted interest there.
Okay. All right. So I think in everything we've said, this could be inferred, but the question that we get sometimes is, okay, well, what if you guys lose all our money? You guys still get paid, right? But from what we're saying, I don't think that's true, right? I mean, we might get some fees.
The only fee we got was the acquisition fee and maybe the debt guarantee fee.
Well, okay. The acquisition fee, yes. Okay. Mm-hmm. But I think how we've explained it is that it really isn't a profit center for us. That basically is just paying for all the time we chase deals.
Yeah, that's
then you have the debt guarantee fee. And I'm going to tell you right now, is if the investment was so bad that we lost all of your money, I'm in trouble on that debt guarantee. I'm definitely in trouble on the debt guarantee, and whatever I got in the debt guarantee fee, 40 grand or whatever, is not going to touch the pain I'm going to go through with that lender. Yeah. That's number two. The asset management fee we get only while the investment was good.
While it gets revenue.
While it gets revenue, and once again, even on a big deal, it's $1,000 a month. Yeah. And so really just handles the clerical and administration of the investment and all the investors. And so then the disposition fee, we're obviously not going to take if we lost everyone's money. And so really this gig doesn't work if we lose investors' money.
If the investor doesn't win, we don't win. Yeah. That's for sure.
Exactly.
If the investor doesn't win, we are in big trouble.
And businesses are built to make money and service the owner, right? It's the same with our business. Our business wins if we win, and we win for you.
And our investors are our owner.
For those that have never invested with us, I've been doing this now for we've been syndicating since 2010-ish timeframe. We've never lost an investor dollar. Yeah. And in fact, we've paid out millions and millions of dollars over what the investors have invested. Now, clarifying, I'm not saying that we won't ever have a deal that loses investor money. But not only have we not lost investor money, we haven't lost any investor original capital, let alone all of it on a deal. Now, like I said, there could be a deal where the worst thing that's happened to us to date is that we've had to pause distributions on properties that we have run into issues, capital events, lost occupancy, COVID. And so we've had to pause distributions, but never have we lost investor dollars.
Yeah, I was going to have a different story. The non-performing GC in the Kitty Academy in Dallas, that scared the crap out of me.
Yes, that did.
But we salvaged it.
We salvaged it.
Okay, so we've talked about all these fees. How do our investors know what the industry standard is? How do they know we're not way above industry standard? How would they?
Yeah, we'll just run through it real quick, just to make it easy. Acquisition fee. It can be 0, it can be 1, it can be 2. Even 3, I don't know that I've seen it any higher than that. If you see it higher than 2, you need to start asking the right questions, especially the larger the deal gets. Yeah. So, if you're going to buy a $1 million deal and the guy's been, the sponsor's been chasing deals for 2 years and he wants to take a $20,000 fee for putting the whole deal together, okay, fine. Yeah. But if it's a $40 million fee, it's $800,000. Yeah. So if he's going to go 3%, 4%, you're going to $1.6 million on that $40 million deal. So that's important. Yeah.
I've personally seen gigs where people wanted us to invest in the deal, and the development fee was 100% giving me pause, just because you have to look at it. You want me to wire you millions of dollars, and you're immediately getting $1 million development fee on this speculative deal
before we know that it works.
And a lot of the times you'll see lenders step in and say, the development fee you can get a portion of at closing, and then the rest has to be paid in installments. And I mean, that's the developer's fee. It's not really our problem. That's why we don't really charge a massive fee on that, is because it's inherently risky.
Yeah. Asset management fee, which is kind of the administration of the asset and the investors.
Yep.
We charge typically 1%. I've seen that higher. I've seen it 2, maybe 3. But the important question to be asking on that is, how are they calculating that? We do it on revenue, and it comes out to be a very nominal fee. But if you're in a fund, and they raised $1 billion, 1% of the fund amount could be, what is that, $1 billion? It's $100 million? No. Is it that much?
1% on $1 billion?
No, 1% on $1 billion is less. It's like 10 million.
Yeah, it's the same thing with financial advisors, right? There's been that study that financial advisors historically can't earn their fee in comparison to what the S&P 500 does, because, I mean, they can't get you 8 after their fee.
Yeah, and so keep that in mind and try to calculate what that asset management fee is based on the metrics that they're calculating on, and just see how much money are they generating here, and are they making enough to be so profitable that they don't really need the investment to make money because they're just generating so much in fees? Yeah. That's the question you got to ask. And so for us, like I said, our typical asset management fee is $500 to $1,500 a month per deal. But if someone's, if it was $10 million a year, an asset management fee or whatever it is, then that's going to be too much.
And again, none of the development projects are paying that. I mean, I would say we get like $2,500 a month in asset management fees. It's just
it's not much.
Doesn't cover it doesn't cover a salary for one person to manage the managers. I'll tell you that.
Okay. So let's go over a couple other ones real quick. The debt guarantee fee. I've seen that as high as 2%. I haven't seen it higher than that. I've seen it at 0. Once again, the bigger the deal, theoretically the lower the debt guarantee fees. So if it's a huge loan and he's charging 2 or 3 points, that's going to be a lot of money up front.
And again, we talked about the only reason we started charging that debt guarantee fee is because we initially had the conversation about maybe not going as high on the leverage and backing down and giving more modest returns. But we decided it was worth the risk as long as we got something in exchange for the risk, because it really does give you multiple points higher returns. I mean, 3-5% pretty easy on the IRR.
Yeah. Okay. Disposition. Did I already cover that? Same thing. 1 to 2 points for us. I don't know that I've seen it any higher than 2 points, and it really needs to be based on, did the deal make money? I don't think people should be taking huge disposition fees if they didn't deliver on their offering their offering memorandum, their pro forma, their IRR targets.
You remember that one building locally where the seller, we were buying a building, the seller touched in with us. He's like, hey, my broker's trying to charge me like a 6% fee on this. What are you guys paying? And we were like, 1%. He's like, oh, okay. I felt like it was a little high. But, I mean, that's locally, right? You always run the risk of somebody taking advantage of you and charging you this exorbitant fee.
Yeah. Now, okay, we're getting long here, but I just have a couple other points. If a sponsor had a fee of 5% on the disposition, okay, great. The only have some restrictions on that, and if he got you to a 40% IRR, maybe he's entitled to that.
Yeah. Sure.
But the great thing about a disposition fee is it's taken at the end when you know what your returns are going to be.
Right.
The problem with the acquisition fee and some of the other fees, if they're taken up front, is you've eliminated the incentive for the sponsor to make sure the deal works.
Yeah, he's already got the money.
That, and always make sure all of these fees are papered, right? All of the fees we mentioned are in our operating agreements and private placement memorandums every single time, and we don't take fees that aren't in the operating agreements. So read the operating agreement.
Yeah, I think we pretty much covered it. At the end of the day, we are 100% aligned with our investors making money. We're typically the largest investor in any one of our deals. And look, we want to incentivize ourselves just enough to keep finding great deals for people. And, like we talk about distribution time 4 times a year, that we love doing that because the more money we make our investors, the more money comes back to us.
Exactly.
And the more people they talk to and the more investors we get. And so we are 100% focused on making our investors money and beating other sponsors and other investing alternatives for them, because we know if we deliver higher returns, we'll get more of the money and we can do more deals.
Yep. I mean, it's true. What I would consider a bad internal return for us is like 15%.
Yeah.
And sometimes I have to remind myself, I would be disappointed, because we're never pitching a deal at 15. I mean, if we delivered a 15% IRR, it would feel like we kind of messed up a little bit.
Yeah.
But then I have to take a minute and I just have to be like, okay, 15%. Nobody is doing a retirement calculation based on 15%. No. Do I want to not perform an expectation I set? Never, right? But like at the end of the day, you get a 15% return. Are you upset about it? No, of course not. You're ecstatic.
Yep.
It's amazing.
I would say that I would invest my money and be happy with 0% returns sometimes, as long as I got 100% of my capital back, and I believe I had a real chance of making 20-30%, right? Because that's the thing about high returns, guys, is it involves higher risk, okay? And so if you're going to try to get 30% IRRs, you're going to have, once in a while, it's not going to work.
Yep.
And so if you can get 100% of your capital back, even at 0% return, having the chance to triple the market on returns, that's a pretty good trade, actually. So I think that's a good note to end on.
Yes, right. Longest episode ever.
It's all right.
Anything else?
No.
Okay.
Don't have time for anything else.
Okay, then Brian, let's go. Do the signature.
Thanks for joining us on How to Invest in Commercial Real Estate. We'll see you next time.
Woo! Thanks, guys.